I'm Grant Walker. Welcome to Last Call for Monday the 18th of May. And I'll be back with Heads Up Tuesday at 10. Let's talk tax. National's capital gains clarification, a game changer or a yawn? Prime Minister John Key faced difficulty when explaining to media today why the government's tax move is not a new capital gains tax, but why it's significant anyway. The new elements to be introduced include a new compliance funding for inland revenue, non-residents and Kiwis buying and selling any property other than their main home to provide an IRD number, non-residents to have a New Zealand bank account to get an IRD number, a new bright line test to tax gains from residential properties sold within 2 years of purchase, unless it's the seller's main home inherited or transferred in a relationship property settlement. Most commentators suggest the effect will be limited. The Taxpayers Union says the more complicated tax rules will have little effect, which is supported by comments from Robin Oliver, a former Deputy Commissioner of Inland Revenue responsible for tax policy. He says Australia had a similar 2-year rule before it introduced a full capital gains tax. Both were ineffective at reducing house prices. Taxpayers Union Executive Director Jordan Williams says the new rules appear more political posturing than a solution to housing inflation. The New Zealand Property Investors Federation says it's comfortable with the capital gains tax on properties sold within 2 years, according to its executive officer Andrew King. He said this announcement is aimed at property traders or speculators, as some people like to call them, not rental property owners. As we have been saying for years, people trading property have always had to pay tax on their profits, and this move will help to clarify this. This should finally put to rest all the unfounded comments from people who say that property has a tax advantage. He warns about unintended consequences, such as sellers holding on to properties longer and therefore reducing supply at the wrong time. Property Institute Chief Executive Ashley Church applauds the measures, but says they are more tweaks than major policy changes and they won't affect house price inflation in Auckland. He says, I wouldn't imagine that there are too many speculators buying and selling quickly in this market because capital growth is so strong. It's more likely that most investors will hang on to their properties for a few years, at least until this current boom has run its course. Mr. Church says moves to identify foreign investors by requiring them to have a New Zealand tax number are also welcome. Mr. Church says the evidence, once collected, will probably show that foreign investors are a far smaller problem than generally believed. Labour leader Andrew Little, just 2 weeks ago, the Prime Minister told journalists introducing withholding tax for non-residents selling houses didn't work in Australia, and now the government's looking at it. It is panic stations at the Beehive. The Greens, they're saying an about face by National that would create distortions. A 10-year bright line would be more useful. Too little, too late. To results, Kiwi Property Group, the country's biggest listed property investor, increased annual earnings 4.5% as it benefited from lower costs after bringing management in-house and is seeking to raise $151.9 million to help fund the expansion of its Sylvia Park retail precinct. The Auckland-based company said in a statement distributable earnings after tax, which strip out movements in the value of its property portfolio, rose to $79.7 million in the 12 months ended March 31st, from $76.3 million a year earlier. Net rental income rose 4.4% to $155.3 million. As a result of the internationalisation of the management contract, net management expenses fell to $9.2 million from $12.6 million a year earlier. Net profit rose 14% to $115.2 million, including a $58.3 million gain in the value of its investment properties. Chairman Mark Ford said internationalisation of management in December 2013, coupled with corporatisation in December 2014, is enabling us to deliver benefits to shareholders, including cost savings. He said our business is now underpinned by both a lower cost management platform and by a strategy that's singly focused on achieving our shareholder goals. Last December, Kiwi Property agreed to buy the Apex Mega Centre for $64 million next to its flagship Sylvia Park site to increase its footprint in Auckland. It also announced a 1-for-9 entitlement offer to raise $151.9 million to help fund the Sylvia Park expansion and repay bank debt. The shares will be sold at $1.20 each and won't be entitled to the dividend announced in today's earnings result. Kiwi Property's board declared a 3.25 cent a share final dividend, taking the total annual payout to 6.5 cents, up from 6.4 a year earlier. Mr. Ford said the company expects to increase the annual dividend to 6.6 cents in 2016. The shares, which last traded at $1.28.5, have been halted pending a book build for institutional investors. The retail offer will open on May 21st and close on June 9. Chief Executive Chris Gudgeon said the company is evaluating a 20,000 square metre retail expansion at an estimated cost of $150 million. and a 7,500 square metre office development estimated to cost about $45 million as part of the Sylvia Park expansion. The value of Kiwi Property's investment property portfolio rose 6.8% to $2.28 billion as at March 31st from a year earlier due to gains in the value of its Auckland assets and the Mega Apex acquisition, offset by the sale of a Queen Street property and the devaluation of its Wellington assets. The occupancy rate rose to 98.4% from 97.8% a year earlier, while the weighted average lease term slipped to 4.5 years from 4.7.
NBR Radio, Monday the 18th. I'm John Stewart. Software company Black Pearl Mail has come up with a system for companies to use everyday emails as a marketing channel. The man who's been covering that story for us today is Tim Hunter, and he joins me now. Tim, first of all, can you tell me how this software actually will work?
Well, I'll try.
Yeah.
So I think the distinction between this service and some of the more familiar things that we might be aware of in email marketing is that this uses the emails that we all send anyway. So we're accustomed to having signatures on the bottom of our email communications, and they might contain some form of branding and identification and so on. And as I understand it, what Black Pearl has done is to create a system that allows you to considerably enhance that, I guess, branding and signature identity, including all sorts of click-throughs and whatever you want to put on it.
So it's interactive.
It can be interactive, and it's under the control of the client. So they don't come along and say, we designed the mail for you. They give you a tool and allow the customer to kind of design it the way they want to.
Right.
So, and they say that this is an underused, I guess, channel of communication. There's something like, 1 billion, more than 1 billion email addresses and more than 100 billion emails, work emails sent every year. And so they say that you can actually learn quite a lot by using this form of communication more carefully.
Have they got any big backers?
Yeah, well, this is one of the interesting things about this little company. They've got some very experienced software people working in the business. The co-founder is a guy called Nick Lizette, who's been involved in this area for quite some time, and they've got a couple of guys who have been successful software entrepreneurs in their own right, also on board. Those guys are Shane Bruins and Simon Rayner. And then after they've done their startup phase, they've brought on board some experienced business people. We've got Simon Botherway, who'll be known to many of us as a former fund manager and former founding chairman of the Financial Markets Authority Establishment Board, if I get that right. And Peter Clare, former chief executive of Westpac in New Zealand. Maybe that's helped them get Westpac on board as a customer. Certainly, I gather that Westpac is trying out their services right now, as is 2 Degrees.
Well, that's a biggie.
It is, yeah.
Is it a very innovative program? I mean, how does it differ from what most email software would offer?
I guess you'd need to really ask an email expert for that. But sure. I think it's in the use of the everyday business mail as the key thing. It's not a spam communication technique or anything like that. And according to the founders, they haven't come across any similar service being made available anywhere. And it's used as a standard kind of software industry model, which is software as a service. So you kind of subscribe to it and can use the services for as long or as short as you want. So I think that's one of the things. And being a software as a service business, they are able to access customers all over the world, right from the word go, in the English-speaking world anyway, for the moment. So I think that's what they're excited about is the global potential of this.
Indeed. Thanks very much for that, Tim.
NBR Radio with Bayleys, New Zealand's leading commercial real estate company.
NBR Radio, Monday the 18th. I'm John Stewart. And I'm joined by our political editor, Rob Hosking, on the line from Wellington. Rob takes a look at the week ahead every Monday. So, Rob, we've had a fairly vigorous start to the week with the announcement of this, what appears to be capital gains tax. How do we evaluate this tax?
Well, this has been looked at for a while. It was looked at very, very closely about 5 years ago and then dropped. This is not a capital gains tax, technically. It is a way of taxing capital gains more than they are currently. That doesn't make it a capital gains tax. This is effectively looking at making part of the Income Tax Act a lot clearer around when it does and doesn't apply to gains on the sale of property. Now, it's a section of the income tax that has been there since at least 1956, and I think possibly longer, but I think gone back to previous incarnations of the Income Tax Act. But basically says that, look, if you look like you are buying a property and selling it with the intention of making a capital gain on that property, therefore that capital gain, the gap between the value when you bought it and when you sold it, that difference is part of your assessable income for that tax year, and you'll be taxed on that at whatever your marginal tax rate is.
So effectively it's an income tax rather than a separate capital gains tax?
It's an extension of the Income Tax Act, yes.
Right.
It's making an area which has been very vague for a whole lot of reasons, including the way it's written and also the way courts have interpreted that, because you could interpret the current writing to include the family home, and most people have agreed that's not what was actually meant. And what this is why they talk about bright lining the test, basically saying we're going to make it clearer by saying that, look, if you're selling it within 2 years, you clearly intended to sell it as a capital gain, therefore it's just going to be automatically part of your income.
Have the courts been fairly consistent in their interpretation of this?
No, they've been all over the place. And to be fair, there haven't been that many cases. What I find interesting is this is an area which the IRD started enforcing more rigorously from around the middle of the last decade. And then in 2007, they were given extra money to enforce it. And then even more money, that amount was doubled in the 2010 budget. Since then, it's been raised again. Yesterday's announcement also says we're going to provide even more money to enforce it. What I find really interesting is, despite the intense enforcement that's gone on in this area, there has been not one test case. It's been settled pretty much every time the property investors have basically folded their hands and ponied up.
Yeah, seems like it.
So this means that effectively they're pretty sure of the ground in this area.
Right, and I think I read somewhere that there's an extra $29 million for inspectors to police this.
Yes.
Yep.
And that's quite an increase on the existing budget allocation. So look, they're serious about this. The thing that I find a little, I've got some question marks about is that 2-year time frame. That seems to me very short. And certainly when officials looked at it 5 years ago, they were asked to by the government in 2010 in the run-up to 2010 budget. They basically said 5 years minimum to be meaningful, and the government has decided that might be politically too tricky, so they've gone for 2 years.
So, Rob, why did they dump it as an idea back in 2010?
I think there was a bit of complacency. I think there was also a feeling that other changes they made, because they stopped the ability for property investors to claim depreciation, I think they decided that was enough. I think it was a big mistake, not just for the effect on the property market, but that was a tax reform budget. That was the tax switch, which ministers talk about, where GST was lifted and income tax was lowered, as was company tax. What happened there as well was, or what could have happened there, I should say, is that, like I said, this is an area of the tax law which is quite vague and quite unclear, and it was the opportunity, I think, to just say, listen, we're going to make it a lot clearer. And there was quite a lot of work when I dug out my file yesterday when this announcement came, because I did a lot of Official Information Act requests on it at the time and dug out the paper trail, and there was a lot of work went on about Treasury and IRD on the issue. Now, the IRD didn't like it much, but the Treasury was reasonably keen, because the Treasury wanted a comprehensive, real sort of full-blown capital gains tax, but figured it wasn't going to get it. So this was their sort of plan B, if you like.
Right. What's the Labour Party reaction to this new tax been?
They did a bit of their initial reaction was, aha, it's a capital gains tax after all. And some of them still, Labour's reaction has actually been a little bit uncoordinated. Andrew Little has said correctly that it's not a capital gains tax. Some of his people have said it is. I think the penny dropped that if they called this a capital gains tax and were going, crowing that the government had to introduce one after all, then that would make it more difficult for Labour to introduce a capital gains tax when it gets into government at some point in the future. And they still, although it's under review, it's still very much part of Labour's policy to introduce a capital gains tax. So obviously it was going to be a bit of an own goal to call this a capital gains tax.
Yeah.
I think Andrew Little's quite right when he says, look, this is piecemeal and this is a bit panicky. In fact, I used the term panicky myself yesterday when Chris Keeler and I did a piece for Online. This does look like it's a bit of a... they've come rather late to this issue, it has to be said, the government. They really should have done this some time ago.
Yeah. Now, looking ahead to the week, we've got a couple of minutes left, Rob, and we've got the budget coming up. Any surprises, do you think, that we can expect? They've probably dropped the biggest surprise, which was yesterday's announcement.
Well, I'm wondering about that because you sort of think if you wanted to have this thing to have a big impact, you would normally put it on budget day. And the fact that they put it out yesterday, when it was obviously going to get a lot of coverage, you release something that's on a Sunday, and also anything to do with property and capital gains tax is going to get a lot of coverage right now.
Yeah.
That to me suggests that there's going to be more to Thursday's budget than maybe we were thinking, because otherwise, otherwise, budget is going to seem a damn squib. I don't think they want it to be a damn squib.
But don't they like to have no surprises these days?
But they don't like to be seen as do nothing either.
Right.
You're right, and that no surprise thing. That is sensible management. The whole sort of thing we used to have, where the Minister of Finance would just get up or go on TV and say, right, there's a midnight tonight. That's no way to run a country. And things are more measured these days. But I think probably more reform in areas around public service, around social services, getting third party, the third sector involved, voluntary groups, etc., in the social housing area. I think there's probably going to be a bit more around that, that extension of social services into basically getting a lot more voluntary groups and a lot more community organisations delivering social services. I think that's probably going to be more on Thursday afternoon.
Okay, we'll watch those spaces. Thanks very much for your week ahead, Rob.
You're listening to NBR Radio. Upgrade to My NBR Radio with a smartphone-only subscription to NBR Online today for free and receive unlimited access to NBR Online on your smartphone until August 31st. Visit www.nbr.co.nz/free.
To the health sector, Caldera Health, a New Zealand biotech company working on a gene sequencing replacement for the world's most widely used prostate cancer test, is seeking new investors to complete a $2 million capital raising to finish clinical studies and put the research in front of potential commercial partners. Auckland-based Caldera has attracted $5.93 million of investment since being incorporated in 2009, made up of $5.4 million from investors including New Image Group founder Graham Clegg, Stephen Tyndall's K1W1, the government's NZ Venture Investment Fund, and about $568,000 from Callaghan Innovation and its predecessors. It's raised about $1.1 million of the $2 million sought in its latest offer of 2.5 million shares at 80 cents apiece. Each share comes with a stapled option to buy another share at that price by 2017. Investors need to put in a minimum of $750,000. In 2012, the US Preventive Service Task Force recommended against mass PSA screening because it threw up both false positives and negatives, didn't distinguish between aggressive cancers and benign strains or even other prostate conditions, and led to overdiagnosis and unnecessary treatments. Caldera's alternative is based on the use of RNA biomarkers to distinguish between healthy and cancerous tissue. The Stage 2 clinical study currently underway is to demonstrate that the genetic biomarkers correspond with what's known as a Gleason score, where prostate tissue from a biopsy is rated on the level of disorganization of cells, a cancer indicator used alongside the PSA that's also regarded as limited because it can't detect whether a cancer is aggressive. If and when a Caldera test is developed, it would be used alongside the Gleason score. Caldera will sell about 23% of the company in its latest funding round, lifting total shares outstanding to 11.1 million and valuing the firm at 8.9 million. The latest funding round will also finance a permanent chief executive, pay for new automated testing equipment, enable 2 more scientists to be hired, and help Caldera executive its partnership strategy, from which it expects licensing revenues to flow. It will also allow the RNA biomarker analysis to be applied to breast cancer, one of the wider applications for the work. The revenue stream generated from licensing fees, which may include an upfront payment or even equity investment, would fund product development for the New Zealand molecular biology company. The company says there is huge potential for considerably more precision in molecular diagnosis as health science enters the world of personalised medicine, where therapies are much more designed to meet individual needs. To tourism, China is expected to overtake Australia as the biggest tourism market for New Zealand in terms of expenditure within 7 years. With a 14% compound average growth rate, China is reckoned to increase its share of tourism spending in New Zealand from 14% last year to 23.6% in 2021, totaling $2.6 billion, as visitor numbers increase 11.6%, according to a forecast released by the Ministry of Business, Innovation and Employment at New Zealand's annual Trends Tourism Conference in Rotorua. Also announced today is the continuation of seasonal direct flights by Taiwanese carrier China Airlines, a leading player in North Asian markets, to Christchurch into the upcoming summer, with 3 connections a week from Taipei in Taiwan via Sydney. The airline trialled the flights first last summer. The anticipated increase in spending by Chinese tourists is partly driven by a shift to more free independent travellers who tend to travel more extensively and stay longer. Meanwhile, Australia will remain the top source of visitors to New Zealand with a 3% increase annually, according to Michael Bird, MBIE's General Manager for Institutions and System Performance. Chinese tourists are expected to prolong the average length of their stay from 18 days last year to 28 days in 2021, while the Australians will continue to keep their stay as long as 12 days, as they come mainly for family and friends. Meanwhile, Auckland International Airport announced today a $100,000 tourism fund to help boost Asian markets in low seasons. Each award-winning seasonal tourism offering will receive $25,000 from the fund, which encourages new itineraries tailored to the rise of free independent travellers. Christchurch International Airport also announced the creation of a New Horizons Fund with a $100,000 annual budget to support a minimum of 2 South Island tourism operators into the China market each year. Also announced today at Trends Conference was the renewal of a joint marketing partnership between Air New Zealand and Tourism New Zealand to spend more than $20 million in the 2016 financial year. They will each invest more than $10 million over 12 months in cooperative marketing activity in the key markets of China, Japan, Hong Kong, Australia, North America, the UK and Europe, as well as activity in Latin America. The emerging free independent traveller market in China is heavily influenced by internet and social media as top information gathering channels for visitors, according to joint research by Auckland Airport and MBIE. The most high-profile effort was Air New Zealand and Tourism New Zealand co-hosting China's top reality TV program, Dad, Where Are We Going?, to film in New Zealand last year, which reached a Chinese audience of 400 million and a further 26 million social media users. To the courts, a court ruling which says bankrupt's KiwiSaver funds can't be accessed by creditors won't be challenged. The official S&E, which administers bankruptcies, has been litigating a test case with trustees' executors over whether it can access KiwiSaver funds. The case concerns 5,559 bankrupts with KiwiSaver accounts, totalling $27.3 million, according to the official S&E's estimates in the case. Last month, the Court of Appeal ruled it was against the intention of the relevant law for superannuation to be made available to creditors, and now the official S&E says it won't appeal. This means any change, if the official S&E still wants it, will be left to Parliament. In a statement, a spokesman for the official S&E says the office is satisfied that the Court of Appeal's decision provides sufficient certainty for bankrupts, creditors and KiwiSaver trustees. It says the official S&E will participate if there are any proposals for reform. DLA Piper partner Rachel Taylor, who acted for trustee firm Trustees Executors, says while the industry had wanted a policy review, the case takes the need away. She says certainly this affects KiwiSaver providers and their members who keep their money unless they have deliberately moved funds into KiwiSaver to avoid creditors. Ms Taylor says she did not expect an appeal because the Court of Appeal panel of Justices Tony Randerson, Rhys Harris and John Wild was so clear in its decision. She says the decision represents a reasonably significant shift from the position that superannuation interests will normally pass to the official assignee upon bankruptcy. The case was first heard in March last year after Trustees Executors refused to release the funds of two bankrupts. The official assignee's position was that bankruptcy was a significant financial hardship and triggers the early release clause for the superannuation funds, which are intended to be set aside until the retirement age of 65.
NBR Radio. With the Property Press. It's out now to show you around.
NBR Radio, Monday the 18th. I'm John Stewart, and I'm here with Jason Walls, our economics reporter, for Market Talk Currencies. And we're joined by Tim Kelleher, who's head of foreign exchange sales for ASB. Now, what's happening with the US dollar, Tim?
Well, some weakness again overnight. The data that came out Friday evening was slightly on the softer side again. So it just reiterates that we think that a movement by the Federal Reserve in June is probably going to be unlikely.
Right. Yeah, because we were just saying before we were on air here, it's being pushed to September, right?
Well, that's when Janet's doing her testimonial, so you'd assume if they're going to make a rates announcement change, they'd want the chairman talking at the time. So there's going to be some major policy change, then it's not going to be a non-announcement meeting.
Yeah, so just for a little bit of background for our listeners here, I mean, US rates are currently at what? Just bone level, right? At 0.258.
Yeah, 0 to 0.25.
They've been at that level since just after the financial crisis, about 2008, right?
Correct, 6 years.
Yeah. So it's a really, really low level. I mean, when you look at New Zealand, we're at 3.5. And, I mean, historically, that's quite low for us. But on a global scale, it's huge, isn't it?
Yeah, we certainly are standing out, hence why our currency's been so strong for the previous 2 to 3 years.
Yeah, and I mean, the US currency, I mean, we just saw that it weakened for the fifth straight week in a row against the euro, didn't it?
Yeah, and interestingly, the euro may be more around positioning in the market. The market was extremely short. Every hedge fund was on the trade, so that's probably part of it. The rest of it is probably that we've seen some pretty good numbers out of Germany, even France last week. So we've seen some fairly vicious short covering in the European bond markets as well. So that's probably pushed the euro up a little bit as well. So
yeah, because I was writing about it last week. It was the first time since 2010 that all Germany, France, who are the big four? Germany, France, Italy, and Spain have actually had positive GDP growth, hasn't it?
Yeah, so it's first time in a long time. But unfortunately, Greece slipped back into recession.
Greece. It's something that John and I talk about often, don't we, John?
We do.
Yeah,
the basket case.
The basket case. And now we just crazy the other day with they made the IMF payment, but apparently what's been reported is that they just used the emergency funds from the IMF to make this payment.
Yeah, so the word is the Bank of Greece knew about the account. The Alex Tsipras didn't know about it. He'd actually emailed the IMF, said we won't be making the payment. This is 2 days beforehand, so now there's a fair bit of pressure on apparently the chairman of the Bank of Greece to step down.
Oh, really?
Yeah, it would be. So, I mean, we've got the Federal Open Market Committee meeting this week. It's on Friday, correct?
Yes.
Yes. Okay. So, what are we expecting? Because always when they release their statements, it's the wording that's important, isn't it? And we're looking for changes in some. Like a couple of meetings ago, it was they dropped the word patience.
Yeah, well, it's a tricky one because one would expect they'd want to telegraph an exit, but not make it that they're backed into a corner. So they probably need to surprise the market at some stage. I mean, actually go and not go by 0.25%, go by 0.5%. I mean, realistically, if your rates go from 0.25 to 0.75, it's neither here nor there. So, but as I said, I think June's too early given the poor data and the GDP forecasts have all been slashed. I mean, every year we get a snowmageddon and they forget that it affects the data for the following 3 to 4 months. Yeah. No different this year. So, as I said, June's a stretch. July's obviously out. There's no press conference, so it makes September the most likely one.
Okay. Well, I'm just saying you said that it's not going to the way that it's going to be hiked. You saying it's going to be 0.5% or a full percent or what?
No, they'll probably go the stock standard 0.25%. I mean, but as I said, if we're sitting here and we had a 0.5% rate move, I mean, from a quarter to 0.75, it's not going to affect your mortgage rate. It's
exactly.
Chicken feed, and they should just get on with the job.
But they'll signal more to come, right?
You would hope so, but they may just go one and done, and that's the problem. So they've got a market, especially an equity market, that is very juiced up on easy money, and I think when we see the move, there will be some downside to those markets.
Now, just looking at the relationship between the US dollar and the euro, they've nearly reached parity at some points. Do you think we actually will see parity between the dollar and the euro?
1.4 at one stage, wasn't it? And that's when sort of the parity discussion erupted. I mean, I saw it on a couple of forums online. I mean, as when New Zealand was very close to Australia, it sort of had the same effect in the US, and there's sort of being patriotic about it and say, like, yeah, we're beating Europe. It's a weird sort of thing, isn't it, Tim? That when people say that we're getting close, it's sort of we're beating another country.
Yeah, there's a lot of sentiment involved, I guess.
So, yeah, I mean, as you were saying before, we saw a lot of good data coming out of Europe. Well, good retrospectively, yeah.
Yeah, so we've had quite a strong squeeze. We're up, 10, 11 euros off those lows. The mumble on the weekend, though, is that the Greeks will be in default by the 5th of June. That's when their next payment is due of 300 million euros. So that came out of an IMF leak on the weekend. So it gives us 2 to 3 weeks to see what goes on. Obviously, they're still negotiating in the background, but June is when the majority of their big payments are due. So I can't see... if they don't get some sort of relief from the ECB, I can't see them making it through mid-June.
Yeah, they've just done a lot of desperate moves. I mean, raiding the pension funds, slapping this 18% tax on tourists and things like that. It's just very desperate times.
Yeah, and so I think the volatility in the euro is going to be there up until that point in time. But as I said, I think a lot of it has been squaring up of market positioning. I mean, hedge funds that never have the trade on have been going, I've been short euro, I've made my money for the year. So it was certainly an almost a lay-down misere once the ECB started QE last year.
Right. Now, last week, Graham Wheeler, the Governor of the Reserve Bank, reiterated that he still considered the currency unjustified and unsustainable, which are key criteria for intervention. What impact has this actually had in reality?
Well, I think it's important to note at this point that, I mean, officials have been saying this for a while. I mean, Key came out and said it. I think Wheeler said it before, right?
Yeah. So, I mean, that is one of the 4 pillars of intervention, is the unjustified and unsustainable. So when, during the Financial Stability Review last week, they omitted the word unjustified, we saw quite a vicious bounce in the currency. Now, I don't know whether that was an error. He certainly reinserted it in the afternoon at the Parliamentary Select Committee, but by that point in time, the damage was done.
Yeah.
And so we saw a pretty strong squeeze again that night up through 75 cents, and then we jumped as high as 75.60.
That's against the US, right?
Yeah, against the US, on that retail sales data, which was just, everyone staying at home eating pizza and buying a new big screen TV.
Yeah. Right.
So the currency's come off since then, but it's certainly one of those 4 pillars. So we were surprised, as was the market, when he initially omitted it. And I'm assuming it was an error, not on purpose.
But he's right, though, isn't it? It is unsustainably high.
Well, I think they're probably quite happy with the level of the Kiwi US. Certainly the TWI, which is what they intervene against, the basket of currencies, is what they would like lower. So you've had Kiwi Euro, Kiwi Aussie and Kiwi Yen all quite high, but dropping now.
Okay, thank you very much, gentlemen, for your insights into the currency markets.
NBR. With a National Business Review smartphone subscription, you can read or listen to the latest from NBR online. And for a limited time, it's free. Join NBR's Intelligent Business Network today and get free smartphone access to NBR online until August 31st. NBR doesn't do sport, weather or horoscopes, just timely, relevant, useful and insightful business news. So for business news you can use for free, visit nbr.co.nz/free.
FBT and public transport. Calls are being made by a transport commentator for the removal of fringe benefit tax on public transport. Transport blogger Matt Lowry says FBT on public transport is an active disincentive for employers to offer incentives such as monthly bus passes to employees. Employee car parks are FBT free, but if an employer were to buy a monthly bus pass or provide a subsidy for public transport for an employee, they would still have to pay FBT. Mr. Lowry says FBT, a tax on benefits employees receive as a result of their employment, should be removed from public transport to, at the very least, give employers more options. Mr. Lowry says in Los Angeles, if businesses offer a car park in an employment package, they're required to offer the equivalent value cash in hand, which encourages use of public transport. He says a similar initiative should be implemented in New Zealand. His comments come after a global survey revealed New Zealanders are spending on average 4% of their take-home pay on commuting. The discussion was sparked after an NBR poll revealed readers did not think it was reasonable for employers to pay employees commuting costs. Regis New Zealand and Australia Chief Executive Paul Migliorini told NBR that the high cost of transport is squeezing household incomes and employers should be doing more to consider flexible work options. Business New Zealand Employment Manager Paul Mackay says if FBT was abolished for public transport, there's no question that it would change behaviours. When FBT was implemented, it stopped employee benefits in its tracks. But he says it would still be a bit of a stretch to assume many employers will pay their employees commuting costs. Mr. Mackay says it would be rare, even without FBT, that the actual commuting was paid for by the employer. Where it's typically occurred is at the other end, the car park type arrangement. Asked to what degree employers should be responsible for employees' commuting costs, some 49% say not at all, with 22% saying employers should be entirely responsible and 29% saying it depends on the commuting distance. In business news, after 88 years as one of Auckland's largest trucking and civil construction operators, Smith & Davies has shut its gate for the final time. Founded in 1927, Smith & Davies is a subsidiary of forestry group Kiwi Forestry International, which is also the owner of Harvest Pro, a Northland and Gisborne-based firm that ceased trading in March, owing creditors millions of dollars. Both Smith & Davies and Harvest Pro presented compromise deals to creditors that were accepted by a majority of creditors by value. In Smith & Davies' case, unsecured creditors are owed $1.77 million, with just $345,526 to be paid out under the compromise agreement. According to a GE Finance and Insurance spokeswoman, secured creditors GE Finance and Insurance and Mercedes-Benz are owed about $11.2 million and $12.5 million respectively. GE had earlier moved quickly to protect its exposure by repossessing certain assets and equipment located in Auckland and Northland from Smith & Davies New Zealand Limited. The spokeswoman added, "We take matters such as these very seriously, and decisions such as this are not taken lightly." But some trucking operators are less than impressed with the outcome and claim the labyrinth of companies associated with the directors has clouded the picture. For example, company directors Zane Cleaver and Andrew Chalmers, a former New Zealand Rugby League chairman, are directors of dozens of different companies registered to 76 Ford Street, Silverdale, near Auckland. According to the company's office, Mr. Chalmers is a director of 52 different companies registered to that address, of which 45 are also directed by Zane Cleaver. Many of these companies have similar names or variations of names and have shareholdings that can be traced back to Kiwi Forestry International. Simon Reed, an owner-operator of a Northland-based trucking firm, says he's owed just over $25,000 by Smith & Davis New Zealand Limited, but he notes that another company, Smith & Davies Limited, is also registered with the company's office. Neither Mr. Chalmers nor Mr. Cleaver nor their accountant, Brent Hempel, have replied to NBR's phone calls or emails. Smith & Davies Managing Director Graham McKinnon says that about 100 jobs were lost with the company's closure, but probably everyone has got another job. We have pretty much placed everyone. Mr. Reid, who runs 6 log trucks and 3 tip trucks in Northland, says he's frustrated by the lack of support for creditors.
NBR Radio, Monday the 18th. I'm John Stewart. Now, Inland Revenue has been gathering evidence using covert visits, including staff posing as customers and business walk-bys, as part of its tax compliance investigation. All sounds pretty cloak and dagger, actually, Hamish. How did the story come about?
Yeah, thanks, John. Basically, late last week, some documents were provided to myself, which showed an IRD investigator's evidence against a business regarding its cash reporting and tax compliance, included notes specifically described as covert visits and walk-bys. And these documents basically showed that as part of an investigation into a business, the investigator visited it a number of times. Quite a few times, or about 90% of the visits, were covertly conducted or undercover. And
So who do they pretend to be when they're undercover?
Well, they're either pretending to be a genuine customer and buying themselves whatever and paying by cash to see how those cash transactions are handled, or some of the occasions they're just sitting outside and observing how that store dealt with its customers.
Right. So these notes, they're pretty extensive, are they?
Yeah, so within these documents it shows basically that during these visits the investigator was counting how many staff were present, how many transactions occurred, how much stock was there, basically every single detail that you'd want from an investigation, but all under the guise of actually being a genuine customer or just being someone in the street, basically.
So what's the context for IRD's
covert
investigations?
Yeah, well, about this time last week, actually, the IRD came out and was heralding its success of what it's calling a declare it all or risk everything campaign, which is basically a crackdown on tradies and the practice of cashies. So they've started this campaign in Auckland's Flatbush, Takanini, Silverdale and Albany suburbs, and it may be rolled out into other areas. And basically they're saying that this campaign is getting them back, or as part of these campaigns that they're doing into the hidden economy, they're getting back about $6 for every dollar that they invest in the program.
That's not a bad return, is it?
No, it's not. We actually specifically asked them about how much these covert investigations, what the return on the investment was for that, and they wouldn't go into any detail about that. No. So it's kind of hard to know, really.
Yeah, it would be. And what's the IRD's response to your questions to them been?
Well, basically, we put all this to them and said, look, we've got all this evidence that this is going on and we haven't heard of it before. Does it happen? And they refused to comment basically on how widespread the application of these investigations is, or how exactly they do it, or whether they do it at all. So they're saying that they have a variety of systems, tools and techniques to help determine how they investigate compliance issues, but because of customer confidentiality, they can't discuss the specifics of it.
Right. Now, have you talked to any other tax specialists for their views?
Yeah, I spoke to a specialist tax lawyer, Jeff Clues, who has more than 30 years' experience, and he says that he's had about 6 cases in the last couple of years where he's seen evidence provided by the IRD where they've specifically done these undercover investigations as well, mostly hospitality businesses within Auckland.
Right.
And he says, so yeah, he's obviously doesn't find the practice surprising at all, and he actually believes that most taxpayers would probably be pretty happy to see them going to these sort of lengths because, I mean, ultimately at the end of the day, these companies aren't paying tax or are assumed or suspected of not paying their fair share of tax, so this is their way of making sure that they do.
Okay, thanks very much for that, Hamish.
NBR. Need to hire? Try our online recruitment platform, www.nbrtalent.co.nz.
NBR Radio, Monday the 18th. I'm John Stewart. Gold is no longer capturing the headlines as it did 5 years ago. That's when it topped $1,800 an ounce in September 2011. In his editor's insight on Monday, Neville Gibson says gold prices are making a comeback. Neville, just what is happening in the gold market?
Well, gold's one of those investments you buy to offset losses from inflation and store wealth at times when the future's a bit uncertain. It's been quite volatile since it reached that peak 5 years ago. In fact, it got up almost to $1,900 and then tumbled by well over $700 or $800 less than a year later. Since then, it's struggled to get back to that level, mainly because inflation has disappeared from many of the world economies, and those sort of prices are not going to recover all that fast. But there's just been a recent sign that prices are gradually improving and have done so far this year.
So where's the price now?
Well, the settlement price on Friday in New York, where they trade futures, was $20.25 an ounce, and that's the highest since it's been in mid-February when prices rose round about when the Greek thing was at a bit of a height. It tends to go up and down depending on whether there's a crisis. And there was when news of slowing growth in China started seeping through, and a lot of the emerging markets like Turkey were also showing quite a bit of a decline. So just tracking the price, it reached a bit of a peak in the middle of January at 1,300, and where it is now at 2025, it's still up 3.5 for the year.
So what actually drives the gold price?
Well, apart from concerns about the future of the global economy, the main price driver in the United States, at least, and that's where most of the gold trading takes place, is the timing of this interest rate increase that everyone's expecting from the US Federal Reserve. On Friday, they were reacting to figures that came out about US wholesale prices. They slipped 0.4% in April. That's a huge amount, and most people were expecting inflation to be picking up a bit in America, so that was really against the trend in the market. So while gold in itself doesn't earn an income, it's actually, you've got to compare it with cash and other financial assets such as bonds. And when interest rates and inflation are about zero, people say, well, we'll buy gold, especially when it goes down just a little, then it ticks up again.
Now, in your editor's insight, you talk about a report. Can you tell me what that report is and what it shows?
Yes, John. The report comes out from the World Gold Council, and they measure what's going on over the quarter. They repeat what the record has been in demand and look forward a little bit. And it shows that global demand actually fell 1% in the first quarter up to March 31, and they attributed this to sort of pretty subdued buying, but consistency is not really a feature of the gold market. It changes quite a bit in different regions and in different sectors. For example, jewellery purchases around the world were down 3%, but the other form, which is bar and coin investments, these came under pressure in some areas where there were strong stock markets in India and China, for example. But in Europe, there was a huge surge, and in fact, sales of bars and coins, which are non-jewellery items, of course, saw a surge of 16%.
So where is most of the world's gold used?
Well, the two biggest users of gold are China and India. They purchase well over half of all the gold that's produced and also used for various purposes. There were two quite contrasting stories, though. In China, demand fell 7% during that quarter, and the Chinese New Year was a bit of a subdued period. Usually it's a big buying time, and the Chinese buyers tend to be quite price sensitive. If the price goes down, they pile in, and if it's up a little bit higher than normal, they keep out of the market. India is quite a contrast. Huge purchasing goes on there, but the thing that has really lifted the gold demand out of India has been the removal of government restrictions there. There's quite a bit of optimism about the Indian economy. It's got a pro-business government, and demand there rose 15%, with jewellery purchases alone rising 22%. They have a number of festivals there, and they had one in April, which was out of the period we're talking about. But that festival, funnily enough, is a time when you start up new ventures and hope for future prosperity, and buying gold is part of that.
Crystal ball time, Neville, but what is the future for
gold
prices?
I can only go by what the World Gold Council are always talking their book a bit, of course, and they say there's signs that the Chinese buyers are back in again. It might be that their recent activity has actually pushed the prices up a little bit, and why we're talking about it. And for the full year, they're looking at demand figures that will be around about 4,200 to 4,300 tonnes, but that's quite a bit up from last year, where it fell at just under 4,000 tonnes, and I think that'll hold the price up till the end of the year, but look forward to quite a few changes in the price in the meantime.
Neville, thanks for your time today.
NBR Radio. Free to air online with business news you can use.
In business news, Dorchester Property Trust, the hotel investor spun out of the financier and insurer formerly known as Dorchester Pacific 5 years ago, has agreed to sell the Goldridge Resort Queenstown to an entity associated with one of its directors for $8 million, just under its carrying value. The buyer paid a non-refundable deposit of $400,000 with the remainder due on or before September 30. The Trust's manager, Dorchester Hotel Property Trust Management, said in a statement. Forecast profits of at least $250,000 earned before the closing of the deal in September will be kept by the Trust, and the proceeds will be distributed to unit holders as soon as practical. Director Paul Burns said, with some funds already held from earlier property sales, we expect this distribution will be the equivalent of near 33 cents a unit on issue in early October. The successful sale of the Gold Ridge brings the total of properties in the Trust sold to date to just over $15 million, and together with profits, this has been achieved at overall carrying values. Units in the Trust, which are listed on the unlisted platform, were halted last week pending the announcement of an asset sale and last traded at 46 cents, valuing the property trust at $12.4 million. The manager said the director took no part in assessing offers received or the recommendation of the sale to the trustee, which was satisfied the related party transaction was adequately dealt with. Today's announcement leaves serviced apartments in the Parkview on Hagley in Christchurch and the Quality Emerald Hotel in Gisborne as its remaining properties, of which the Emerald was seen as the most complex property in the portfolio. The asset sale comes as trust investor LET Securities, owned by directors Deepak Gupta and John Southworth, seeks to replace the current manager of the trust at a special meeting on May 29, saying Dorchester Hotel Property Trust Management hasn't returned capital to investors quickly enough. The Dorchester manager disputes the claim and has put forward its own resolution to be voted on at the meeting for it to accelerate the time frame within which the remaining properties are sold to no later than July 31st, 2016, with the trust to be wound up by November 30, 2016, when new rules come into effect that mean the trust manager will need to be licensed by the FMA, incurring additional costs. To Green Star ratings, innovative design and waste minimisation helped BNZ achieve a 5 Green Star office interiors rating for the 2 newest floors of its central Auckland office. When BNZ expanded its 8-floor tenancy in the Deloitte building at 80 Queen Street to floors 9 and 10, it undertook a Green Star interiors fit-out to ensure the new space was energy and water efficient with an environment that supports team working. Throughout the fit-out, BNZ either reused or recycled 97% of construction and demolition waste, exceeding Green Star benchmarks. The floors are flexible workspaces, meaning no one has an assigned desk and people can work anywhere depending on the task they're doing. There are shared collaboration spaces in the premium corners of the buildings, which benefit from natural light and external views. Joe Monaghan, BNZ Workplace Design Manager, says this helps people use space more efficiently, leading to lower energy consumption per employee. She says the aim of the project was to look at how we could create a new way of working which was flexible and efficient and gave the highest quality spaces to the staff. Pre- and post-occupancy surveys show that they feel the new spaces are more closely aligned to the BNZ brand and culture, and they feel more productive in them. This demonstrates the success of the project, which is contributed to by both the quality of the internal environment and the design. BNZ has a strong record of providing Green Star rated interiors for staff. The bank's fit-out of the Harbour Quays building in Wellington was the first 6 Green Star office interior rating. Its fit-out of Key Park 1 in Auckland also achieved a 5 Green Star office interior rating. New Zealand Green Building Council Chief Executive Alex Cutler says BNZ will reap the rewards of its commitment to sustainable offices, from cost savings to the positive impact on staff well-being. Ms. Cutler says the value of Green Star for an office fit-out is that it provides a sound framework and independent validation that you've achieved a high-quality environment for staff. Paying close attention to light levels, air quality, energy use and healthy material choices all bring tangible benefits for occupants' health, well-being and productivity. And as BNZ's research shows, they're reaping the benefits through staff satisfaction.
NBR Radio, Monday the 18th. I'm John Stewart. I'm here with court reporter Victoria Young to discuss bankrupts with KiwiSaver funds. Victoria, there is a test case underway at the moment. Can you tell us what that case is about?
So this test case between the official assignee who administers bankruptcies and a trustee firm, Trustees Executors, is actually pretty much at the end of the road. The case was about how Trustees Executors refused to release the KiwiSaver funds of bankrupts to the official assignee so they could be distributed to creditors.
So how many people does it impact?
Well, the reason why it's quite an interesting test case, even though it was only about those 2 bankrupts, is because, looking at the wider picture, the rule concerns, almost 6,000 bankrupts which have KiwiSaver accounts that total $27.3 million. That's according to the official S&E's estimates in the case.
So what did the High Court say?
So back in the High Court stage, the official S&E said that bankruptcy was a significant financial hardship and therefore there'd be an early release clause for the superannuation funds, which, as we know, are supposed to be set aside until the age of 65. And the High Court agreed with that. However, this went up another level and the Court of Appeal said no, and so made quite a change in the law so that the position was not that superannuation interest passed to the official S&E. So, quite an interesting decision by the Court of Appeal.
So what's the latest development?
Well, while many thought that this would go up to the Supreme Court, our nation's top court, the official S&E has said, no, that's it, we're not appealing or taking this any further. And this has been welcomed by trustees, executors, lawyer, DLA Piper partner Rachel Taylor. And she says it's good because basically it means legislative reform is not needed. Back at the High Court stage, the judge, Justice Ronald Young, had indicated, oh no, we definitely need legislative reform. But obviously as that's been overturned and there's no appeal, this means that, those with KiwiSaver providers and creditors of these people all have the certainty, whether they like the law or not. It's all certain now because it's the end of the road for the case.
Right. Victoria, thank you very much for that.
NBR Radio. With Clooney Restaurant now offering Auckland's most exclusive private dining room. NBR Radio.
I'm Grant Walker with Last Call. Here's what's trending on NBR Online. Kiwi Property Group lifts earnings, the PM on foreign investors and those new rules, further reaction to the new tax and tips from the tax man. Smith & Davies goes under, calls to incentivise public transport, and the service sector slows in April. To find out more on those stories, log on to nbr.co.nz or stay tuned. Those stories coming up now on NBR Radio. To the PM, John Key said this morning the onus will be on non-resident property sellers to claim tax back under new rules previewed yesterday. The new regime, which will form part of Thursday's budget, will require foreign home buyers or New Zealanders living offshore to have a New Zealand bank account and an IRD number, and tax gains if a property is sold within 2 years, unless it's the buyer's main home, inherited or transferred in a relationship settlement. Mr. Key said on Breakfast this morning, basically, if you're a non-resident, we're going to get good information on you and you'll have to pay the tax because we're going to withhold the tax when you sell the property, and you're going to have to come and get it from us as opposed to what we do at the moment, which is try and get it off them, which we never can. Asked if the new focus on property tax was a U-turn, the PM said supply is the biggest issue. I don't think what we announced yesterday is going to come anywhere near to fixing the supply side. It was not a crisis, but prices are rising more than we would like, he said. Asked if housing affordability in Auckland had reached a crisis point, Mr. Key said, I don't agree with that. House prices are rising faster than we would like, but if you go to Sydney or Melbourne, any major capital in the world, and pick up a paper, you're going to find house prices rising as fast or faster. But he said what we announced yesterday does help because we know people are rorting the system because in Budget 2010 we gave IRD $33 million more to hire inspectors. They've raised $250 million from people rorting the system. So he said, all we're saying is if you buy and sell an investment property in 2 years, you can try and claim you were renting it, but in reality you were there to make money, so that's very clear now. On whether the tax rule tightening could reduce supply by taking investors out of the market, Mr. Key said genuine investors will still buy property without doubt, but if your intention was to buy and sell quickly, then actually if you rort the system and don't pay tax, you will be caught. That will free up some supply for more genuine buyers. Let's talk bursting bubbles. When a local NBR rich lister begins to look askance at the property market, it may be time to sit up and take notice. Rapaki Group's Simon Henry's investment portfolio is valued at about $130 million. He reminded NBR that few people saw the immediate triggers for the meltdowns of 1987, 98 and 2008, even though in hindsight they were inevitable. Mr. Henry said, when the next crash comes, it will seem obvious. At the same time, he's not sure the housing bubble has reached its zenith. He says a $350,000 house purchased on a mortgage rate at 9%, common during 2006, is about as affordable as a $750,000 house on current rates of 5% or less. If interest rates go lower, property will be even more affordable. I don't think, he says, the Auckland market is going to crash immediately because of the number of cashed-up Asians coming in. However, Mr Henry remains a seller of real estate currently with projects in Christchurch. He has diversified his interests into the chemicals business. Meanwhile, the chairman of the Australian Securities and Investments Commission, Greg Medcraft, is also warning the Australian housing market is moving into bubble territory. He told the Australian Financial Review the $550 billion self-managed super sector was particularly exposed to a correction in prices. History shows people don't recognise a bubble until it's over, he says. He's most concerned about the Sydney and Melbourne property markets. Mr Medcraft says the long-term average income to average price ratio is 4 to 5 times in those areas, but at the moment it's at historic highs.
NBR Radio, Monday the 18th. I'm John Stewart. An Auckland trucking and civil construction company, Smith & Davies, has ceased trading after 88 years. Jamie Ball has been covering that story. Now, Jamie, why have they ceased trading?
In short, because one of their secured creditors, GE Finance and Insurance, have moved to repossess assets and equipment last month that were located in Auckland and Northland. So that's the short answer. The long answer is we don't know. We don't know what's behind that. And efforts to attain greater or more deeper information on the finances behind have been fruitful to this point.
Yeah. One can only assume, however, that they do owe people money.
We can only assume that, yeah. They owe $11.2 million to GE Finance and Insurance and $12 million to Mercedes-Benz. And that's just a couple, that's 2 of the 3 secured creditors. And then there's dozens and dozens of unsecured creditors who are the people who would appear who maybe last left on the heap in terms of the options they have available to them. There was a move there approved for a creditor compromise list, so that basically they got back 20 cents in the dollar. And that would appear to, that will apply to all the unsecured creditors. But there's great contention about that because to get that passed, one has to have 75% of creditors by value rather than quantity. And some of the values that have been put in as to how those sums have been totaled up are questionable, to say the least.
Right. So what's the connection with the story you've done on Harvest Pro?
Yeah, the two seem to mirror one another. Effectively, the most important thing to remember is the same 2 directors. There are 2 company directors, Mr. Zane Cleaver and Andrew Chalmers. Andrew is a former New Zealand Rugby League chairman. They're directors of dozens of different companies, all registered to the same address in Silverdale, which, according to the Companies Office, Mr. Chalmers is a director of 52 different companies, of which 45 Mr. Cleaver also co-directs. He's a fellow director of. So Harvest Pro went under in March with the loss of about 200 jobs.
That was a forestry company.
Correct, yeah, a forestry company. Sorry, I should have explained, in Northland and around Gisborne. But in terms of the manner in which it's folded and the lack of transparency to its creditors about its financial situation seems to mirror Smith & Davies, along with the fact of presenting in an identical format and fashion this creditor compromise deal.
Now, will there be any job losses, do you think, as a result of this latest action?
Well, according to Graham McKinnon, he's the managing director of Smith & Davies, he says there were about 100 jobs were lost with Smith & Davies closure, but he says probably everyone has got another job. We have pretty much placed everyone, is what he says. I guess time will tell. We'll do a follow-up and see if that is the case and trying to get more information as to where those people are and if they have been relocated, what they're actually doing.
So what now for Smith & Davies creditors?
Well, Smith & Davies creditors and the Harvest Pro unsecured creditors have a large overlap between the two. They are talking about organising some sort of a class action type case to take against the directors, but we'll see if that ever comes to be. At this point in time, most curiously, to the best of my knowledge, no liquidator has been appointed, which is a bit unusual in this situation. So perhaps there's more to come on this front from a liquidator point of view.
Indeed there is. Jamie, thanks very much for that.
NBR
Radio.
Free to air online. NBR, the meeting place of intelligent business.
Business news. Cook's Global Foods expects to open 150 Esquire coffee stores in China in the next 5 years after signing up to a joint venture with Chinese retail and property investor Bubugao or Better Life Group. The deal with the Shenzhen-listed retail and property investor will see Cook's open 30 stores in the Hunan province by 2020, according to the Auckland-based company. That boosts its planned stores in China to 150 by 2020, making it the chain's fastest-growing region and is part of Cook's plan to have 800 stores worldwide. Cook's operates 21 stores in China, employing 130 people, making it the third largest Kiwi non-government employer in the People's Republic. In June 2013, Cook's agreed to pay Esquire's founders Stuart and Lewis Deeks $300,000 in cash and an undisclosed number of shares for the franchisee rights for the coffee houses worldwide, excluding New Zealand and Australia. The coffee chain has stores in the UK, its largest market, Ireland, China, Saudi Arabia, Bahrain, United Arab Emirates, Kuwait and Canada, and is now pushing into Indonesia and northern Cyprus. Bubugao has annual sales of $2.7 billion, employs more than 70,000 people and operates 373 retail outlets, including supermarkets and shopping malls across several provinces in China. It also has $2.2 billion under management in its property portfolio and is active in online commerce and finance. Cook Executive Chairman Keith Jackson says the venture is a continuation of our strategy to drive growth in China by partnering with significant domestic businesses that can provide the resources, retail expertise and local knowledge that are prerequisites for success in the region. These capabilities, coupled with a Chinese Esquire's coffee management team that understands how to translate the brand's unique take on New Zealand cafe culture into domestic settings, gives us great confidence in the potential of the business to grow. In December, Cook's increased its first half loss to $1.2 million in the 6 months ended September 30 from a loss of $831,000 a year earlier after buying the Canadian franchise rights to Esquire's coffee houses, completing its ownership of the brand outside New Zealand and Australia, and spending more to expand its global footprint. Operating income was $4.3 million from zero a year earlier before it embarked on a franchise buying strategy in October 2013. Shares of Cook's last traded at 14 cents on the New Zealand Alternative Index and have gained 3.7% since the start of the year. And now, tax tips. Just because you rented out your investment property doesn't absolve you from paying tax, says the Inland Revenue Department in a summary of commonly made mistakes by non-professional property investors when it comes to their tax liability. Even if you sell it after the 2-year Bright Line test to be imposed from October 1, the IRD's Property Compliance Program, or PCP, investigators can come after you if it was always your intention to sell for a swift gain rather than hold the property. The Bright Line test and requirements that foreign buyers have IRD numbers and New Zealand bank accounts are the government's latest attempt to stem rampant house price inflation in Auckland. The announcement amounts to a tightening of existing law that counts the proceeds from trading in property as personal income rather than a capital gain, and is therefore taxable, while adding new requirements for foreign investors. However, the IRD's Property Compliance Program is already busy. It estimates it will assess undeclared tax of $56.6 million this year against a target of $45 million after the 2010 budget voted a 4-year $33 million funding package for chasing property tax compliance. The government is forecasting the PCP will assess around $84 million of extra tax a year, following the addition of $29 million in extra funding over the next 5 years, taking total spending on property compliance activities to $62 million over the next 5 years. That implies the IRD won't have quite as much success as its phenomenal rate of return in the current 4-year period, where $1 spent on compliance has netted $7.80 in unpaid tax. Over the next 5 years, the IRD is forecasting it will collect around $6.20 for every dollar spent on PCP. In theory, the PCP applies all over the country, but in emailed answers to questions from Business Desk about the existing law last month, the IRD says there are natural hotspots of activity such as Auckland and areas of the South Island, which receive a more intense focus from speculators and therefore Inland Revenue's property compliance program. The department listed several common misconceptions and ruses that can get both professional and hobbyist or one-off residential property investors into hot water, and they include: we often deal with people who buy a property in a hotspot area with the idea of renting it out for a short period and then selling it. Sometimes these people mistake the gain made as capital in nature when, in fact, due to the intention of resale from the outset, the profit is taxable. People who buy properties to renovate and sell are sometimes unaware the profits made from such sales are generally taxable. We look at new developments to identify speculative trading in those developments. An example includes land and building packages purchased and then quickly sold on upon completion, some as many as 3 times in the first year. We look at GST refunds where no taxable activity has taken place and look into incorrect application of the compulsory GST zero rating rules for land transactions. We also monitor properties which have been the subject of historical GST claims to ensure these are treated correctly when sold. The PCP investigates property transactions including property development and speculation, residential investments that cross into property dealing, off-the-plan sales and land banking. It focuses on ensuring people speculating or trading in residential property are meeting their taxation obligations. The IRD says this includes everything from one-off speculative transactions or those developing a pattern of dealing. Let's talk tax. Inland Revenue has been gathering evidence using covert visits, including staff posing as customers and business walk-bys as part of its tax compliance investigations. But it's refusing to comment on how widespread the application of undercover investigations are, saying it will not disclose specifics of how it investigates potential compliance issues. Documents provided to NBR online show an IRD investigator's evidence against a business over cash reporting and tax compliance includes notes from cover visits and walk-bys. The documents show the investigator visited the business a number of times, initially covertly, and only once as an official unannounced spot check declared to the business. In total, about 90% of the visits were covertly conducted. The notes are extensive, counting staff numbers, customer numbers, stock, as well as cash and FPOS transactions and how they're handled. An IRD spokeswoman says it has systems, tools and techniques to help determine the best action to take when investigating potential compliance issues. But due to customer confidentiality, it's unable to discuss individual cases. The spokeswoman says to protect the integrity of our work, we would not disclose specifics about the techniques and methods we utilise. What we can say is we tailor our approach depending on the particular circumstances to ensure taxpayers meet their tax obligations. The IRD did not respond to questions over how widespread the covert investigations may be or how much it costs. But specialist tax lawyer Jeff Clues, who has more than 30 years' experience, says he has probably had about 6 cases in the past 2 or 3 years in which evidence was gathered undercover by the IRD. He says he does not find the practice surprising and believes most taxpayers would be happy to see non-compliant entities investigated in such a way for the purposes of recovering tax. Last week, the IRD heralded the early success of its Declare It All or Risk Everything campaign, which is a crackdown on ensuring tradies declare cashies. The campaign, which has identified tradespeople as being a high-risk sector for tax evasion, is running in Auckland's Flatbush, Takanini, Silverdale and Albany suburbs, but may be rolled out to other areas. Last year, the IRD got back about $6 for every dollar invested in its hidden economy program. The IRD spokeswoman says it encourages people to talk to it early if they're facing tax difficulties. The IRD says it's very difficult to get away with not meeting your tax obligations.
NBR Radio with Hotel de Brett, your home away from home, but with better service. NBR Radio.
In business results, Wynyard Group, the security software firm, predicts annual revenue will grow as much as 73% this year as it presses ahead with a number of contracts and gets closer to finalising a major distribution agreement in law enforcement markets. The Auckland-based company expects revenue of between 40 and 45 million this year, up from 26 million last year. The software developer signed an undisclosed number of new contracts and extensions in the first half of this year and expects to finalise a significant national security solution for delivery in the second half of 2015. It says it's also in the final stages of securing a partner distribution deal for its crime analytics product across the US and global law enforcement markets. Wynyard says it's on track to expand its global sales and services operations. Its workforce will grow from 228 people to 330 by the end of the year, building a global distribution network and launching new products. The shares were unchanged at 174 and the stock is rated an average hold based on 2 analyst reports compiled by Reuters with a medium target price of 223. Shareholders will get an update on its performance and vote on electing Richard Twigg and Lewis Griever to the board at its annual meeting in Auckland tomorrow. They will also vote on whether to issue 216,000 shares to Transformation Services at $192 apiece to pay for consulting services provided by the firm, which is associated with former Wynyard director Herb Hunt. The last resolution shareholders are being asked to approve is a change to Wynyard's constitution to allow a listing on the ASX, something the company aims to do in the third quarter of this year. Wynyard flagged the proposed secondary listing on the ASX in March, saying it would enable more Australian and foreign investors to hold the company's stock, though it won't raise any money from the listing. To the services sector, and growth in New Zealand's service sector, which makes up about 2/3 of the economy, slowed in April as stock inventories and supplier deliveries dropped. The BNZ Business New Zealand Performance of Services Index fell 1.1 point to 56.5, with all 5 sub-indices remaining above the 50 level that separates contraction from expansion. The April reading was lower than the same month a year earlier, reading at 58.4. Business New Zealand Chief Executive Phil O'Reilly said the key indicators of activity sales and new orders business remained over the 60-point mark, which bodes well for the short term in terms of growth. However, its sister survey, the PMI Manufacturing, has seen some inconsistent levels of expansion for 2015, so we'll be monitoring whether this flows through to the PSI in the short-medium term. Last week's manufacturing survey showed activity slipped in April, although remaining in an expansionary mode for the 31st consecutive month. The BNZ Business New Zealand Performance of Composite Index fell 1.2 points to a GDP-weighted index reading of 55.9, while the free-weighted index declined 1 point to 55.4. Government figures showed spending on electronic cards dropped 1.1% in April, in part driven by a drop in consumer retail spending. Meanwhile, first quarter retail trade rose 2.7% as cheaper fuel and a higher exchange rate boosted spending. Bank of New Zealand senior economist Craig Ebert says he expects a slowdown in second quarter retail trade given the drop in spending on electronic cards. Today's PSI showed stock inventories slipped to a reading of 52.7 last month from March's reading of 57.6. Supplier deliveries declined to 50.1 from 53.6, while employment slipped to 53.6 from 54.8. Activity sales edged up to 60.4 from 60.1, while new orders business increased to 62.6 from 60.9 in March. Catherine Rich cleared of those allegations. The Auditor-General has cleared Food and Grocery Council Chief Executive Catherine Rich of conflict of interest allegations arising from the dirty politics affair. Complaints were made that she was compromised as a member of the Health Promotion Agency, or HPA, which backed public campaigns that may affect the activities of companies selling alcohol, tobacco and other products. In a letter to HPA Chairwoman Dr. Lee Matthias, Acting Assistant Auditor General Edric Child says after considering the issues raised and looking at relevant documentation, the office has decided there are no issues to investigate further. The inquiry included interviews with Dr. Matthias and Chief Executive of the HPA, but not Mrs. Rich. It said, "We're satisfied that there are no matters we need to investigate further. We have not identified problems with the management of conflicts of interest by the HPA." Mr. Child says a conflict of interest does not arise simply from a person's background or their involvement in a sector or industry. He said rather it's necessary to point to a specific connection between the person's other interest and a particular matter or decision coming before the public entity. He says it's too simplistic to assume the aims and activities of the HPA and FGC are incontrovertibly opposed and utterly incompatible. It went on, for a problem to arise, there would have to be some particular substantive act or decision of the HPA board that clearly affected or was affected by something arising out of Ms. Rich's FGC role. The letter concludes by saying Mrs. Rich made a full disclosure before she was appointed by the government and that the office would not investigate other matters raised in dirty politics.
Join NBR's Intelligent Business Network today. www.nbr.co.nz/subscribe. NBR.